Welcome back, everyone. This is episode 4, and that means we have been at it for an entire month. Let's keep the momentum going, and I hope you're learning some really valuable lessons. Today, I want to throw down some cold truths. I want to talk to you about the principles of investing and what makes it different from trading and speculation and other things that you may have heard about that really are not investing. Because before we go into the specifics of getting your money to work for you by investing and making more money, we must talk about how an investor operates. What are the rules for a good investor? What are the rules that the good investor lives by? Not everyone buying stocks or any other form of investment for that matter is an investor. First is the issue of time. Investors always take the long view and take the long-term view, and this means usually 5-10 years minimum. They do not care what the market is doing today or tomorrow. Therefore, investors generally put money to work that they will not need in any time soon. And soon here means in the next 6 months or even sometimes 2-3 years. Think of it as money you can definitely afford to lose all of it. Although your goal as an investor is to get positive returns and turn your money into more money, but this won't happen tomorrow, in a week, a month, or even a year. Good investment can take time to pan out and generate a good return. Traders and speculators, on the other hand, are people who buy investments for the short term or very short term, taking very high risks to make a quick buck or dollar. Investors tend to actually beat out, and there's data on this, everybody over the long term, because holding and waiting means you reduce transaction costs that add up by frequently buying and selling investments. For example, if I went to buy a stock, the bank would charge me for every time I buy and sell that stock. And if I buy and sell a lot of positions, obviously, the transaction fees over time will be adding up. Then there is the volatility of the stock market. People usually panic and end up selling low and buying high, which is the opposite of what you want to do. But those who take a very long-term view wait out this market volatility and keep an eye for the very distant far future. For example, in a given year, a typical stock could be down or up 50%, and you don't want to be selling when you're down 50% and taking the loss at a panic. Secondly, as an investor, you also look to compound your returns. So what does that mean? It means that any returns you get on your stocks and holdings, such as dividends, we take this and we don't spend it as if it was a paycheck. We put it in to buy more investments. This is called reinvesting. Always reinvest your profits, just like most good businesses do. This will allow your money to grow even faster. This is why businesses grow so fast, because they take their profits that they're gaining and put it back into the business to grow it even faster. Compounding just means getting more returns on top of your returns. And mathematically, it looks like an exponential curve which really takes off after a while. Just how you save consistently so you can add to your investment accounts, you should not take the gains from your investments unless you really need it to splurge on ridiculous things such as fancy toys, but instead you should reinvest it and buy more investments. This might sound really conceptual right now, but as you learn about the different forms of investments, it will all start to make more sense in the coming weeks. There we go. The 2 very fundamental principles the investor lives by. If you live by just these 2 principles, you will do great. It sounds really easy in theory, but in practice it can be hard, especially when there are very bad days, weeks, or even months in the stock market where your net worth keeps going down every single day and all you see is red. I know personally this has happened to me, and this can be very emotionally and mentally tough. you can start doubting yourself and your choices. But always keep a long-term view and tell yourself that you are an investor first. And in the long term, sticking to your principles will make you really wealthy. You have to stick to these basic principles in a disciplined manner, no matter what happens. Good luck, and I hope you're excited for next week when we'll be talking about Banking 101 with all types of all types of important issues such as debit, credit, savings, and checking. Although, if we really understand it, it will all become simple. So come join me next week. Peace.